podcast. I'm delighted to be joined today by two people who've been with us many times and before. Bill Spindle, former Councillor on Foreign Relations, International Affairs Fellow in India. Paul Hicken, Editor-in-Chief, Petroleum Economist, and joining us for the first time, Sushant Gupta, Research Director for Asia Pacific Refining and Oils Markets at Wood Mackenzie. Thank you so much for joining us, gentlemen, this morning. Bill, if I could start with you, please. We just had that survey result up, which was a poll that we put to our viewers yesterday, which was what will be a big supporter of oil prices in 2023. Of course, the assumption is that the answer would give us China, majority. But there have been, and in volume, certainly that's the case, even with China still coming back. But that is the question to you this morning to start us with, which is, how is the return of Chinese demand, if you like, as expected thus far for the year, and what's the outlook for you for the next couple of quarters?
Yeah, I think it is. I think we're seeing both India and China. India's come out of COVID quite a while ago and does seem to have its economy moving along pretty steadily at this point. So they're really adding to demand now. And China is coming along pretty much, I would say, as expected. This PMI numbers came in, a little above expectations. But we're looking at a pickup in demand that's going to gain momentum through the year and put pressure on prices. Oil prices going into the latter half of the year, almost certainly.
Okay, well, as you said, pick up as we go through the year, and a lot of commentary we've had in the last couple of weeks is that we're really not going to see that kick in any significant way till the second half of the year. Two reasons. One is domestic growth is taking its time to get back. Secondly, that they've got a lot of inventories. So are those the factors? Is there something else?
Yeah, I think that. Yeah, those are the factors, and we'll see how those play out through the year. I mean, obviously, China's got longer term structural issues that are going to come into play over the longer haul, but it is still definitely working its way out of its no COVID close downs into this much more open world. But that's as it's taken every place in the world, that takes time and will gain momentum as the year goes on.
Okay, Sushant, welcome again for the first time on the program. Let's get your take on, again, Eastern market. Look at China, but maybe beyond that, in terms of the demand picture for the year ahead. How's that going so far? Include China in the equation, but please talk to us a bit more about the other Asia Pacific.
Sure. I think first, I would agree with Bill's views in China. Now, I think we believe that the oil prices this year will be largely influenced by the demand growth in the emerging economies. Very different picture from last year. So if you look at the overall demand growth for this year, we are forecasting 2.5 million barrels per day of demand growth year on year. Now, out of the 2.1 million barrels per day comes out of emerging economies. And out of the 2.1, a million barrels per day comes out of China. So almost 40% of the global demand growth comes from China. And we're not surprised by looking at the survey results, which were shown just now, that people do expect China to rebound. There is a substantial source of pent-up demand growth to come from China, from mobility across diesel, gasoline, jet fuel, that will all come across. And India obviously, has been robust demand growth last year, close to around 300,000 barrels per day. This year, we're expecting close to 250,000 barrels per day for India's demand growth, which again will add to the overall demand growth in emerging economies. I think the only risk I would highlight is the emerging economies also face pressure from depreciating currencies across the US dollar, which actually could potentially make the import bills much higher for many economies in the emerging economies, which could pose a risk for some of the growth factors in 2023 for these economies.
Yeah, of course, currency risks and debt, and we'll get maybe into that a little bit more afterwards. Thanks very much, Sushant. Paul, welcome again. Let's talk about in general direction for oil prices. Today, as we sit at the beginning of March now, we've seen a pretty steady-ish range for the last couple of months compared to the volatility we saw last year. So should we expect to remain stable this year, if you like, nothing like last year's range.
Well, it's interesting that being at IE week at the moment, we did a poll at the Platts event, and most of the participants said $80 to $100 they expected that price to be next year. Now, you could say that's a common thing with polls, that people tend to gravitate towards where the price is right now, and that's a common feature. But there does seem to be a fragile balance in the market, and with the Bill and Sushant talked some good points about the general narrative of the market, but I think, and that was been the topic around IE week, but at the same time, you've got to remember that there's a little bit of a fixation on these kind of proverbial wild cards of China demand and Russian supply. When you think about it, you know, the OECD, inflation, the demand side there has dropped off. That has almost been an anchor to the sort of China rise story. And in the same way that Russian supply, the drop off or the expectation that's not really materialized from Russian supply, that's sort of been countered by a sort of North America supply story and some of the supply that's been increasing there. And everyone's been talking about the US in terms of, and capital discipline and the US production not really coming back in the same way, but it's coming back. And that's often offsetting a lot of that potential Russian drop-off, which is not materializing in the same way. So there is that fragile balance, and it's a narrative that will play out throughout 2023, I think.
Okay, well, I mean, what you talked about, so the supply side, there's more supply creeping in gradually. You've got even members in OPEC like Nigeria, Libya, who were having a hard time last year. Again, there's some recovery there, etc. American supply, debatable. Bill, just to go to you on that, in terms of, you know, what we've seen in terms of the impact so far on Russian supply. Last year, pretty much, looking at oil, zero impact on the whole. You know, it still made its way around the world, if you like. I'm getting the sentiment that that's going to still be the case even this year, 1 year on, including with products that, yes, there'll be more ton miles, etc. Prices will be affected, but that product volume is still going to get to markets.
Yeah, I think that's right, because that's everyone's intention. You know, the Russians certainly intend to get as much of it out of the market as possible. And as much as the US, the discussion around the US is around price caps and all that, you know, the intention of the US, the whole design of it is to get the oil to market. And, you know, on the margins, if they can, you know, shave a little bit of revenue off the Russian side of it, that's a win for them. But the main goal, and they've proved this throughout, is to get that Russian oil to market to prevent spikes. So I think that'll continue to happen with the provisos you said. It's going to be shipped longer distances. It's going to be shuffled around. It's going to be put on boats that, you know, it's just not going to operate as efficiently as it did. And to some extent, everybody kind of splits the cost of that and tries to, you know, the one side tries to push it on the other.
And what about the outlook that actually, okay, that's true, but also that these sanctions, price caps, etc., will at some point this year start to be a cost on Russia, i.e., it's going to have to, you know, drop its production because of technical reasons, because it can't afford certain things. It's putting all its money towards the war. It cannot, you know, afford to sort of keep it up its production. Are we going to see any impact from that this year or not?
I think it's slowly eating away at some of this. I do think Russia's paying a price for it. They certainly would prefer to be doing it another way. Is it a debilitating price? I doubt it. I doubt it's going to really undermine, you know, broadly what they're doing, but it does, you know, it does eat away at the margins, and that's really the intention of it all. I don't think it's going to be a game changer. Okay.
Sushant, let's go back to India as well and talk about Asia, but within that, we have an article on our bulletin this morning, which is saying that Indian throughput at refineries, is at a record high since 2009. Oil prices are in the 80s, and you know, last year or a few months ago, India would have been still complaining about that oil price, but at the moment, it seems to be fine with it, projected to grow 15% GDP this year, etc. Is the Indian economy now immune, really, to this current oil price, given that its engine is sort of going again?
So I think it's quite a number of things here, right? I mean, so one, at higher prices, one, there's a larger pass through to the consumers since last year because of the higher taxes. And second, I think one of the reasons why Indian crude runs are higher is also because of the steep discounts of the Russian crude, which India is buying. So India is in January, India is currently buying close to around 1.3 million barrels per day of crude, almost 20-25% of the overall crude runs, right, which is quite significant, discount at more than $40 per barrel. That actually what does is it inflates the refining margins and it increases the capability of refiners to export more products into the market. So it's not necessarily for the domestic demand, which they're running more crude, they're also exporting a lot of products to the other markets. Now, I think the only cash there is that if the logistical challenges, if India wants to buy more and more crude, will slowly increase, right? I mean, because there are only so many vessels which can be deployed for this service. At some point, this and plus the crude, so import ban on the product side as well. So that also starts playing out. We've seen, so once those two factors come together, we could see that if Russia is unable to, export both crude and products at the same level, we could see that, tightening the vessels market, and that could potentially lead to a lower Russian production in our forecast.
Okay, so yeah, and the shipping side of things, of course, is pretty critical as well. Bill, just to go back to you on that before I go to Paul on exports, we mentioned, Sashant was mentioning India sort of refining a lot, but exporting a lot as well. What about China's product exports? We saw those pick up in December, and it's got a lot of inventory, I suppose, to keep that going as well, crude inventory. The outlook for that, the evidence there in the market at the moment of whether that trend is likely to continue.
But either Paul or Sashant might have better thoughts on some of that. I think because China's demand's picking up internally, that probably will mean they're going to pick up some of that more domestically and perhaps import or export less, but I would be curious to hear what you other guys have to say about that too.
Okay, well, what about the domestic demand in China? I mean, in the sense that in terms of it, it's meeting now, I think next week it has, the lawmakers are meeting for the first time in terms of in full capacity since COVID, setting out the reviewing plans for the coming year, economic plans, etc. The whole stimulus to the economy, etc. We've seen that trickle through. What are the expectations there that we're going to see that continue for the year, or perhaps even stronger measures to boost that?
Yeah, I think China's pretty determined to do what it's got to do government-wise to push demand to levels that they get some sort of respectable amount of growth, and again, that just pushes off a lot of structural issues and certainly won't solve a lot of their problems, but it's a big government, they can push that spending up and get the economy kind of back on track this year, and then begin to try to sort through some of these longer term issues later.
Okay, Paul, let's talk a little bit about, we talked about supply earlier in terms of incremental supply to the market, that seems to be available more or less, maybe not immediately, but will be this year. OPEC, was there any talk of OPEC or OPEC plus at IE Week in terms of, they've set out their policy as far as we can tell for the year, and they're being quite clear that, we're not going to budge, we're going to just, we're going to wait and see. But again, and taking into account the whole Russia angle on that as part of the bigger group, what was the sentiment at IE Week on that in terms of the big producers there?
Yeah, well, one of the big topics we're talking about is what it means for the Russia and the OPEC relationship, the OPEC plus dynamic really going forward. The 500,000 barrels a day are coming off the market from Russia in March, in this month. You look at some countries in OPEC that have been sanctioned and have been exempt, like Venezuela and Iran, but they are a different kettle of fish. Russia, the OPEC plus is a much looser alliance, and it's really formed on the Russia-Saudi relationship and the ability of those two massive producers to be able to influence the market and manage the market. If Russia's not really part of that in the same way, what does that mean for OPEC Plus and OPEC generally? Because OPEC wouldn't have the market power without Russia. A lot of the OPEC countries are feeling capacity constraints. So it was really a question in the audiences and people I spoke to on the sidelines were really questioning, like, later the year when demand potentially picks up, especially if we talk about China and elsewhere, and demand comes through, and if OPEC starts to ramp up, OPEC Plus starts to ramp up production again, if they need to, they will. But where does that leave quotas? And that was certainly a big complication, a big talk about, well, what does it mean for OPEC Plus? And we were there a couple of years ago when the dynamic between Russia and Saudi, they fell out and they quickly patched things up to how important it was for the market. And clearly this relationship is going to be crucial for the market going forward. So it was certainly one everyone was talking about.
Okay, Sashank, just back to you on gas. Let's talk a little bit about gas. Let's just look at the poll question there. Will the market see more or less Russian fuels supply in general this year versus last year? More or less. That's a simple question, maybe, but maybe a good one, given we were just referring to is, how much impact, if any, are we going to see on actual Russian production this year as these sanctions sort of take more, maybe hold more weight. But as Bill was saying, the intention is that Russian oil continues to flow. So Shan, just to talk about gas, we can talk about Asia, obviously in the context of Asia, but in the context also of Europe. Last year, we post-war beginning, gas prices obviously rocketed. There was a lot of panic about Russian gas supply, then it was cut off. But of course, Europe got its act together and demand also fell. Asia also was vulnerable to that, including China. Are things a little bit more relaxed on that front now that prices have come down, first of all, or is there a chance that we could see gas prices spike this year as Chinese demand, for example, takes off?
But I think it's a very similar story to oil, right? In the last year, there was always the fear of loss of supply from Russia with the sanctions, and and finding those alternative sources for gas, was over the big question mark. Now I think we have seen overall a large LNG imports into Europe has actually replenished some of those inventory levels, and prices have come off. Very similar story to what we have seen for oil, particularly for diesel, for example, as a heating oil. So this year we still expect that the LNG demand to remain strong across Asia and Europe, which actually will continue to support the prices, but not to the same level as we have seen last year, because we now do not have that fear of supply from loss from Russia.
Bill, let's talk a little bit about India and its intake of Russian oil. Clearly, it took in record amounts for its record. I think it was taking in 20% of Russian oil last year, which was a huge leap for it, for obvious reasons. There's an article on our bulletin today that just says that India is still taking Russian oil. The US says that's okay because it's kind of abiding by the price cap. But projection going forward. Is that obviously likely to continue? And is there any reason why India would not continue to do that?
Yes, I think it'll definitely continue going forward. I mean, you were talking earlier about why is India not screaming about higher oil prices at the moment? Because for India, the prices are not that much higher because they're able to buy this Russian oil at a discount. They'll keep doing that. They're getting great refining margins, as Sushant pointed out. So they'll continue to try to do that. Because of the product ban that's now in place, there's going to be a reshuffling of the product end of things around the world, and that's going to keep things kind of complicated. It's hard to see how much more of it. It's hard to see India, ramping up a lot more, because it does seem like it's reached some of its natural limits, and it's going to continue to get complicated. But it'll definitely continue. India really feels like this is it's part of its kind of strategy going forward, is to opportunistically take advantage of this as long as it can for both its own needs and its product exports.
And how healthy are the Indian coffers looking at the moment in terms of budget, in terms of government revenues? Obviously, it was also spending a lot of money on subsidizing expensive fuel last year and the year before. How is that looking now in terms of, how that's impacting its budget and its policy?
Yeah, always tight, always complicated. But I think, probably maybe a bit easier than last year, depending on what's to come. And, a lot of that, you were talking about gas prices, a lot of that's going to depend on weather going into the winter, for Europe as well. They really got away with a very mild winter. And that could change the complexion of everything if that were to dramatically change this winter.
Paul, your outlook for gas and gas sort of price expectations, if you like. Let's look at Europe specifically on that. A lot of sort of efficiencies that were brought in last year, a lot of new LNG. So again, same question to you really. Is Europe pretty relaxed now as we head, as far as heading towards the next winter, it's got itself sorted in relation to the Russian equation?
Yeah, so I disagree with Bill in the sense it wasn't that warm in Europe this winter. Certainly had the heating on still, but maybe relatively speaking, it was okay. Yeah, I think there was a lot of lessons learned for Europe. They got their storage up well in advance, paid a lot of money for it. They got it up so that they filled those to 80%. They got to that target ahead of time. They're in a lot better shape now coming out of the winter. But the storage levels are much higher than they were this time last year. There's less mileage to go in terms of topping up that storage, even without Russian supply. They had the Russian supply during the up until sort of a big chunk of last year. They're not going to have the same level of supply coming through, but at the same time, there's less space, less room to go. So there is likely to be less pressure. But at the same time, there are certainly not out of the woods. There's no one is getting complacent in Europe, given that, like the speaker said, weather is still going to play a part. Still, the factors around Asian demand is going to play a big part as well, and it could still be a bit of a battle for that gas. And what happens generally when this battle happens is some of the smaller countries in Asia end up losing out. I heard your webcast yesterday, and talking about Pakistan and others and Bangladesh who often suffer when they can't get the gas. So they're at the margins. They're often the big losers. But at the same time, still prices could still be a factor at the end of this year, even if there's less room to go in terms of topping up that storage.
Bill, let's get your perspective, because I believe you're based in the US, aren't you? At the moment, I know you're
for the last months, yeah.
Yeah, but let's talk a little bit. We'll touch on geopolitics as our last point in a couple of minutes. But just let's talk about US. If you could give us what you're hearing in terms of US production. I mean, not to get too technical, but that again, last year everyone was saying, well, prices were so healthy, and the industry just wasn't really responding to that. Shareholder value, dividends, etc., as reasons given. But projection for this year going forward, are we going to see any major shift in an extra US production if it's needed?
Yeah, I think what Paul said, I think creeping up is the right way to think about it. It's you're not going to see the fundamental dynamics of this shift. There's still a huge demand, particularly in the unconventional oil sector for returns from investors. Those pressures are going to continue, but it is creeping up, and I think it will continue to creep up.
Okay, and so Sean, just back to you on the debt point that you made earlier in terms of emerging market debt, currency weakness against the dollar. How much? Obviously, we've seen a strengthening dollar in the last few years, but some people are saying now it's kind of stabilized, might start to weaken a bit. What impact will that have? We see a bit of stability on, we've got all nations are in debt, including the US and the Western economies, and that's considered the biggest problem for all the central bank policy now that's trying to manage the situation. But in terms of emerging market debt, currency weakness, where is that going, and how much is that going to impact those economies in terms of growing this year if oil prices, let's say, remain the same and commodities and continue to see the same levels of inflation?
Yeah, I think the pressure will mount as we head into the year. So we expect oil prices to appreciate towards 88, 90 or even $94 per barrel, by year end, and that's when I think the pressure will start mounting. Now, the other side of the equation is it also depends upon the U.S. Interest rates hikes. We think they will moderate over time. Given the inflation is showing some signs of moderation, and that would actually, do the offset some of those increases for the emerging economies. Now, in terms of the import cost, obviously it'll increase over time for the Asian economies because they're huge importers of oil, and particularly the smaller economies, right? I mean, the bigger economies such as China, India, they can sail through, but the smaller economies as mentioned by Paul, the Pakistan, Bangladesh, and other economies where they have to rely more on imported oil and crude. They will be the big sufferers, as we head towards the year end.
Certainly, those nations, Bangladesh and Pakistan, is really stuck. It's reminding you of the situation that Lebanon has. It can't move beyond its problems. Let's look at that result before we go back to Bill. Will the market see more or less Russian supply? Less. That's pretty big majority there, 83%. I was get the feeling that we're not going to see less. That was what people were saying. They were saying that at the end of last year, but it seems that things will continue. Of course, it all depends, Bill, where the war goes. And where's the expectation there? Geopolitically speaking, should we interpret anything from the recent sort of moves or meetings between China and Russia, its top diplomats visiting Putin, etc.? Are we going to see any change in stance, do you think, in terms of support or for Russia or neutrality towards Russia by those nations that showed it last year?
I think it just seems like a real slog going forward. It's really hard to see it ending. One is tempted to say it's hard to see either side sort of breaking through or making big gains, but that could happen. But it is still, even if say this Russian defensive kind of what little they've been able to muster peters out and the Ukrainians are mount a counteroffensive, it's still extraordinarily difficult to see a way that it's going to somehow get settled or ended anytime this year. China, will it come in? A lot of debate these days, will China come in and support Russia with some sort of armaments, perhaps on the margins, and again mainly to prevent the Russians from losing, as many are sort of accusing the US on the other side is just staying in there enough to prevent the Ukrainians from losing. So it's a little hard to see breakthroughs, but it's a war, so it's always very difficult to predict.
Well, was there any talk at IE Week about Iranian oil production, Iranian exports doing much better in the last few months than they have been in terms of during the sanctions period? I mean, they're not doing great, but better, let's say. Again, was there any talk of that, the resumption of JCPOA talks, or dead in the water?
I think there didn't feel like there was a mood shift on Iran, but at the same time, you've got to look at Iran and Venezuela as, how much the US is going to be focused on those two and allowing the sort of wiggle room. They've already seen a little bit from Venezuela, and Iran has been going under the radar for a long while and been managed to export quite a bit of its crude and condensate. So I think that is likely to be the situation going forward. It seems to be a slow burn with sanctions generally. There's been real regime changes anywhere, and it seems to be like Bill was talking about, this kind of like a nuisance factor, but at the same time, everything seems to continue. Most of it under the radar. Yes, there is some drop off, but not that much.
Okay, so Shant, let's get your take, and all of you perhaps, for the year ahead, this year ahead, in terms of oil price range. Where would you put that sort of range from now to the end of 2023?
Well, I think for quarter one, I think we obviously have seen prices remaining stable at around $84-85 per barrel. As we head towards quarter two, we expect a larger appreciation in prices, driven by the stronger demand growth we expect in China. We discussed that. So quarter two, global demand growth will be close to around 2.9 million barrels per day. So that really pulls the prices up in our view towards $88 and $90 per barrel for average for quarter two. And now overall, if you look at the overall year 2023, right, we still expect oil prices to keep on appreciating because the demand growth is 2.5 million barrels per day. But on the other side, the supply growth, we expect around 2.1 million barrels per day after including the US growth, OPEC, plus growth, and also, the growth in other markets such as Brazil and Norway. So 2.1 versus 2.5, we're still seeing, supply growth lagging behind the demand growth. So prices are again supported in the second half of the year, more than $90 per barrel.
Bill, I mean, the support also is coming from US economies, and even Europe isn't going to slow down as much as was being expected only a couple of months ago. But the US economy, despite Fed policy, which is kind of like, yo-yoing right now, but it's also being clear that we're going to keep going on this inflation fight. And yet the US economy is just, it's fine. We're not going to have recession, right? I mean, would you bank on that today? We're not going to see a recession in the US this year.
I wouldn't bank on that. It does seem like that's a wild card that's out there, that the US economy continues to chug along right through all these interest rate cuts. But at the same time, you're definitely seeing a Fed that is, I think, quite determined to keep pushing rates higher until inflation really does come down far below where it is now. I think, some of the core stuff is around 6% or something. I think they're going to push quite hard. And if it takes a recession, and it may take a recession to push those rates down, well below, say, 4%, you can see a recession for sure.
So they will keep pushing below that. But although there is a bit of talk that they're not perhaps going to push as far as 2%, depending obviously on what happens in the interim with GDP and everything else.
Yeah,
so
I think they need to get it down to 4% before they start talking about 2%. But they're determined to keep pushing it down.
Yeah, and markets aren't being very patient. I mean, equity markets, etc. They kind of still want to talk the story up, and then they were sort of declaring the Fed policy over a week ago, but that's not quite the case yet. Gentlemen, thanks so much for joining us. Bill Spindel and Paul Hicken, and for the first time, Sushant Gupta. Thanks so much for joining us today. Have a great remainder.
Thank you.
Thanks for having us.
Great to have you.
Thank you.
Thank you.
Thank you.